Wall Street is once again talking about a crisis, and this time it's not about theories, but about specific signals already emerging within the financial system. A former head of Goldman Sachs has openly stated that he feels a new wave of problems approaching, comparable to 2008. Major banks are restricting access to investors' funds. Shares of financial companies are dropping by tens of % in just a few months. And all of this is happening against the backdrop of an overheated tech market, a debt bubble, and an energy shock. But here's the key question. If a crisis is truly forming, why are some market participants not losing, but instead feeling completely comfortable in these conditions? The answer is that different market approaches respond to instability in different ways. And while long-term investors are looking in drawdowns during this period, intraday trading enters a completely different environment. In this video, we'll break down the signals Wall Street is sending right now, why they matter, and how much periods can be used within intraday trading. Let's get into it. One of the main sources of tension right now is forming in the private credit segment, a market worth $3 trillion. This sector grew rapidly after 2008 crisis, when traditional banks faced strict regulation. As a result, a significant portion of risky lending moved from banks into less regulated structures. For a long time, this worked because investors saw strong returns. But by the end of 2025 and the beginning of 2026, the first serious disruptions began to appear. Several major defaults in this sector became a signal that's hard to ignore. And it was this moment that a key phrase from the head of JP Morgan stood out: "If you see one cockroach, there are probably more." Now, this means that current problems aren't isolated cases. They're the beginning of a chain reaction. Now, additional pressure comes from the fact that many of these assets are illiquid. In other words, investors can't quickly withdraw their money. And as soon as the withdrawal restrictions begin, tension rises. Now, because the market starts asking a simple question: where is the money? This is exactly how the effect we've been seeing before starts to form, when problems in one segment begin spreading across the entire system. The issue in private credit is only part of the bigger picture. Now, at the same time, several other factors are developing in parallel and reinforcing each other. The first is an overheated stock market. Right now, the total market cap of US equities exceeds 200% of GDP. That's significantly higher than the levels seen before the 2008 crisis, and even higher than the peak of the dot-com bubble. Now, this means the market is already in a zone of increased vulnerability. The second factor is the artificial intelligence sector. At the moment, it's driving a major share of economic growth. But at the same time, a large number of companies are not generating sustainable earnings. Think about that. This is a classic bubble model where valuation growth outpaces real financial performance. And if this segment starts to correct, it would impact the entire market. Now, the third factor is the energy shock. The conflict in the Middle East is already putting pressure on resources prices, and that directly affects inflation, and as a result, the consumer sector and the broader economy. Now, as a result, we get a situation where multiple systemic risks are stacking on top of each other. Private credit, an overvalued stock market, a bubble in the tech sector, and rising energy costs. Now, this kind of combination, it's what's called a perfect storm. And in these conditions, the market starts behaving differently. But there's one thing that only becomes clear through real market experience. Understanding what's happening is only part of the task. The key question is how to act in this moment. And this is where theory alone stops working. Because during a crisis, the market doesn't give you time to think. Decisions have to be made quickly. And price doesn't care. It doesn't wait. That's exactly why, based on feedback from regular viewers, the greatest value comes not from standalone videos, but from live breakdowns in real time. Because you don't just see the result, you actually see the decision-making process itself. This becomes clear why an entry is taken here and why it's skipped in another situation. Now, if you want not just to watch the market, but to understand how to work with it in these conditions, join the live streams on the Pocket Broker channel. Subscribe so you do not miss upcoming streams and new videos on beginner strategies. Now, let's break down why a crisis changes the market environment itself. When the market is in a stable phase, movement becomes limited, not just in amplitude, but also in structure. Price moves slowly. Impulses are weak, and most moves fade quickly. In such an environment, even a correct idea often doesn't get enough follow-through. That means the environment itself limits opportunities. But as soon as tension in the system, the market begins to change its behavior. And the first thing that increases is movement amplitude. Price starts covering more distance in less time. The second is reaction speed. And the third is the imbalance between buyers and sellers. It's this imbalance that creates movement. And this is the key point, because intraday trading doesn't depend on market direction. It depends on the presence of movement. If price is actively moving up, that's a workable environment, right? If price is actively falling, that's also a workable environment. The direction doesn't really matter. The presence of momentum does. You see, during a crisis, such impulses appear more frequently and they become more pronounced. This means the number of trading opportunities increases, not just in quantity, but in the quality of movement. In a calm phase, the market often chops around a level, right? In a crisis phase, a level is either held sharply or broken with acceleration. This makes price behavior more readable in real time. And that is why the effectiveness of short-term models increases, such as breakout trading, momentum trading, and trading pullbacks to levels. In this environment, the market reacts faster, and it doesn't require long waiting. For an investor, this is higher risk because price can move against the position, right? For an intraday trader, it's an acceleration of the decision-making cycle where each setup plays out over a short period of time. Now, this reduces dependence on long-term forecasts and shifts the focus to current structure. At this point, what matters isn't where the market will be in a month, but what it's doing right now. That's why, in crisis conditions, the entire logic of trading changes. The market becomes less predictable in the long term, but more active in a shorter timeframes. Now, this creates an environment where decisions are made faster and results depend on reaction, not waiting. This is exactly what makes crisis periods workable for intraday traders. Now, when the market enters a phase of instability, not only the speeds of movement changes, but also the way trading setups form. First of all, the number of impulsive moves increases, and these impulses become cleaner without prolonged fluctuations. Now, this means breakouts start playing out faster and deliver movement without long stagnation. The second key point is level behavior. In a calm market, price often tests a level multiple times. In a crisis phase, the scenario simplifies. Either the level holds immediately or it breaks with acceleration. Now, this makes decisions more straightforward. Now, the third point is pullbacks. After a strong move, price often returns to a level, and these pullbacks create continuation opportunities. In this environment, the key task is not forecasting, but working with what has already happened. This leads to a very simple conclusion. The higher the volatility, the less important long-term opinions about the market become, and the more important the current structure is. That is why intraday trading becomes more relevant during such periods, because it allows you to work within the movement instead of waiting for it to finish. Now, the conclusion for all this: if you want to understand how to work with these movements in real time, not analyze them after the fact, join the live streams on the Pocket Broker channel. It is in this format that you can actually see how decisions are made intraday during high volatility, where it's not enough to just spot a move, but to understand when to enter it and when to skip it. Stream recordings are available in the stream section. The link is in the description and pinned under the video. Subscribe to the channel and make sure you turn on the notifications so you don't miss new breakdowns. Now, if you put it all together, the logic is simple. Wall Street is pointing to a rising systemic risks. The market is entering a phase of instability. Volatility increases movement, and movement is the foundation of intraday trading. And that is why a crisis is not just a risk, it's a shift in the environment. And the question isn't whether there will be a movement. The question is, how are you going to work with it?